योगः कर्मसु कौशलम्.
Hello students, I welcome you all for the session on angle of incidence, margin of safety and sensitivity analysis in CVP analysis. In the previous session, utility of break-even analysis, its limitations, types of break-even and break-even analysis practical applications have been discussed. In this session, the focus would be on angle of incidence, margin of safety, the relationship, key factor or limiting factor, sensitivity analysis in CVP analysis, and concept of cost indifference point and its practical computation. Objectives: to understand the concept of angle of incidence, its importance, to understand the concept of margin of safety and its computation, to understand the relationship of angle of incidence, break-even and margin of safety, to understand the concept of key factor or limiting factor, to obtain the understanding of sensitivity analysis in CVP analysis, to explain the concept of cost indifference point and its computation. Let's understand the concept of angle of incidence. Angle of incidence, its meaning and its importance. The angle of incidence in accounting occurs when the entire sales line crosses the cost line from below in the break-even chart, or it is an angle that gets created due to the sale and cost line intersection. Usually, this angle starts forming at the break-even point, indicating how efficiently the company is making a profit. Further, the angle suggests that the rate at which the company is making profits. The higher the angle, the more is the profit, and vice versa. A large angle of incidence means the company is making profits at a higher rate. Similarly, a small angle suggests the profit is being earned at a lower rate. A narrow angle reveals high variable cost, which becomes a cause for low profits. Management always aims to maintain as large an angle as possible. Business experts suggest one should be studying together safety of margin and angle of incidence for examining soundness of a company. If margin of safety and angle of incidence are considered together, they will provide significant information to management regarding profit earning position of the undertaking. A high margin of safety with a wider angle of incidence will indicate the most favorable conditions of the business. Thus, for a business, a desirable situation is a large angle of incidence with a high margin of safety. It could further indicate that the business might have a monopoly status in its industry. In simple words, the angle of incidence is the one that is formed due to the total sale and total cost line intersection. The angle originates from the BEP, that is break-even point. It represents the whole area between the two lines. The larger the area, the bigger is the profit that a company is making, and the more cushion the company has in times of distress. It indicates profit earning capacity over the break-even point. It should be remembered that a large angle indicates high margin of profit after covering fixed cost. In the graph, the area represented by dotted portion shows angle of incidence. Let's understand margin of safety. The difference between the total sales volume and the break-even volume is known as the margin of safety. It may be expressed in monetary terms or as percentage, that is, the margin of safety in relation to total sales. It is a guide to the financial strength of the company. The larger the difference, the safer the organization is from a loss-making situation. It can be calculated either in cash or in units. Margin of safety can be derived as margin of safety is equal to actual sales minus break-even sales, or margin of safety in cash is equal to profit to be divided by PV ratio. Margin of safety in units is equal to profit to be divided by contribution per unit. Margin of safety ratio is equal to margin of safety sales divided by actual sales into 100. This term was given by Benjamin Graham and David Dodd in their book Security Analysis. The margin of safety is useful when the sales of organizations are at risk. The margin of safety can be increased by the various methods. Increasing the selling price provided sales are not affected. This is possible in case of inelastic demand of product. Increasing production and sales up to the capacity of the plant. Reducing the fixed expenses or variable expenses. Substitute the existing product with more profitable products. From the product mix, remove the product whose contribution ratio is very low. What does it indicate? Higher margins of safety provides greater protection to the company. The size of margin of safety is an indicator of soundness of business. It shows how much sales may decrease before the firm will suffer a loss. Sales beyond the break-even point represents margin of safety. It is necessary for the management to know the margin of safety as it shows the strength of business. It works as a buffer when sales decline and there is a loss. Margin of safety shows how close the BEP sales is to actual sales. The bigger the margin, the greater is the capacity and capability to withstand the depressionary trends, as profits will be earned even if there is a large decrease in actual sales. Let's understand the concept with the help of an example. Current sales are 2 lakh units per annum. Selling price is rupees 6 per unit. Prime cost are rupees 3 per unit. Variable overheads rupees 1 per unit. Fixed cost are rupees 3 lakhs. Calculate PV ratio, break-even point and margin of safety. Sales is 6 rupees per unit to be multiplied by 2 lakh units, so you get rupees 12 lakhs. The total of prime and variable cost is 8 lakhs to be deducted to derive at the amount of contribution, that is rupees 4 lakhs. So, PV ratio is contribution upon sales to be multiplied by 100. So, 4 lakh divided by 12 lakhs into 100 will give you 33.33%. Break-even point is equal to fixed cost to be divided by PV ratio, which is equal to rupees 3 lakhs divided by 33.33, which will give you rupees 9 lakhs. BEP in units is equal to fixed cost upon contribution per unit, which is equal to 3 lakhs divided by 2, which is equal to 1,50,000 units. Margin of safety is equal to actual sales minus break-even point sales. So, 12 lakhs minus 9 lakhs will give you 3 lakhs. Margin of safety in units is equal to profit upon contribution per unit. So, 1 lakh divided by 2 will give you 50,000 units. Margin of safety in rupees is equal to profit upon PV ratio, which is equal to 1 lakh divided by 33.33, which is equal to 3 lakhs. Let's take one more example. If actual sales are rupees 50 lakhs and sales at break-even point is rupees 30 lakhs, then what would be the margin of safety? Also expressed in percentage. Margin of safety is equal to actual sales minus sales at BEP, which is equal to 50 lakhs minus 30 lakhs will give you 20 lakhs. Margin of safety in percentage is equal to actual sales minus sales at BEP to be divided by actual sales. So, 50 lakhs minus 30 lakhs to be divided by 50 lakhs will give you 40%. Now let's understand the relationship between angle of incidence, break-even and margin of safety. In order to understand the relationship between the three, it is important to understand all the concepts. Margin of safety is basically the limit to which the actual or estimated sales exceed the break-even sales. You get margin of safety ratio after subtracting the actual sales from the break-even sales and dividing the result by actual sales. In simpler terms, the margin of safety measures the business risk. A company with a higher margin of safety is more likely to sustain the volatile conditions and maintain its sales. However, if the sales drop more than the margin of safety, it would result in a net loss for the period. If the break-even sales are low and the angle of incidence is large, it reflects that the business is stable. This would also mean that the margin of safety would be high. If the break-even sales are slightly lower with a moderate angle of incidence, we can consider the business to be stable. However, the company is not making as much profit as in the first case. A third situation is where the break-even sales are higher, the angle of incidence would be narrow, and the margin of safety sales would be low as well. From the above information, it is clear that the angle of incidence is related to the break-even point. Thus, one should study it along with break-even point, otherwise it won't give any meaningful information. Now let's understand the concept of limiting factor or key factor. The resources are scarce and not available in plenty, because of which the capacity to produce gets limited. Such a scare factor becomes a key factor or limiting factor. For example, if there is a good sales potential and skilled labor is also available, but the required material to produce is in short supply and not of required quality, then the raw material becomes the key factor or limiting factor. In order to maximize the profits through optimum sales mix, it becomes important for a company to consider the limiting factor. It can be defined as a factor which puts a limit on the total production or sales and on profit of a business. According to the marginal costing principles, scarce resources should be utilized for products which would contribute to high margins. When the information regarding contribution and key factor is available, the formula to be used is profitability equal to contribution upon key factor. If raw material is in short supply, then profitability is equal to contribution upon units of raw material. If labor is the key factor, then profitability will be equal to contribution upon direct labor hours. Let's understand this important concept with the help of a numerical example. From the information, recommend the product to be manufactured, time being the key factor. Direct materials per unit for product P and Q are Rs 58 and Rs 38 per unit. Direct labor at Rs 2 per hour, for P it is 4 and for Q it is 6. Variable overheads Rs 4 per hour, for product P it is 8 and for Q it is 12. Selling price per unit for product P and Q Rs 210 and Rs 230 respectively. Time allowed to produce a unit for P 2 hours and for Q 3 hours. These calculations will show contribution per unit for each product. We will first calculate contribution for P and Q, that is 210 minus 70, which will give 140 rupees per unit of contribution for P, and 230 minus 56 will give you contribution of 174 for Q. Then contribution per hour is calculated using formula contribution to be divided by number of hours. So for P, 140 divided by 2 will give you 70, and for Q it would be 174 divided by 3 will give you 58. So product P is recommended as its contribution per hour is high. Let's understand with one more example. In a factory producing two different kinds of products, the limiting factor is the availability of labor. From the given information, show which product is more profitable. Materials for product P and Q are 15 rupees each per unit. Labor is 3 rupees per unit for P and 1 rupee 50 paisa for Q. Overheads 1.50 fixed for P and 0.75 for Q. Variable overheads is 1.50 for P and Q each. Total production for the month in units for P 1000 and for Q it is 1200. Maximum capacity per month 4800 hours. Let's understand that here number of hours is the limiting factor. Production units are multiplied by rupees 15 per unit of material to get material cost rupees 15,000 for P and rupees 18,000 for Q. Labor cost is obtained by multiplying rupees 3 with number of units to get rupees 3,000 for P and rupees 1800 for Q. Variable overheads 1.50 into 1000 for P, that is 1500, and similarly for Q, that is 1800. Total of variable cost is the summation of materials, labor and variable overheads. So for P, the total variable cost is 19,500 and for Q 21,600. Selling price for P is 24 per unit to be multiplied by 1000 units to get rupees 24,000 for P, and similarly for Q rupees 21 into 1200 to get 25,200. The contribution is sales minus variable cost, so for P and Q it is 4,500 and 3,600 respectively. The labor hours for P is 6,000 and Q it is 3,600. So contribution per labor hour is contribution to be divided by labor hours. So for P it is 0.75 and for Q it is 1. As the contribution per labor is more in case of Q, therefore product Q is more profitable. Now let's understand sensitivity analysis. Sensitivity analysis is a system which examines the effects of changes in any of the inputs on the results. In case of CVP analysis, sensitivity analysis means to examine what would be the net profit if the sales volume changes, or what would be the net profit if the variable cost per unit increases by 15%. Let's understand effect of change in variable cost. Suppose a trader hires a stall in a trade exhibition by paying rent of rupees 6,000. He buys an item at rupees 4 and sells it for rupees 7. So students, fixed cost is rupees 6,000 and variable cost is rupees 4 and sales price being rupees 7. The contribution would be rupees 3 per unit and break-even point will be 2,000 units using the formula fixed cost upon contribution per unit. Suppose the variable cost increases from rupees 4 to rupees 5, then contribution per unit will be reduced to rupees 1 and the new break-even point would be 3,000 units. On the other hand, if variable cost is reduced to rupees 3, his contribution will increase to rupees 4 and the new BEP would be 1,500 units. Thus, the sensitivity analysis helps the management in knowing the effect of any change in input on the break-even point and on the profit. Let's understand the effect of change in fixed cost on sales and profit with the help of an example. Suppose the fixed overheads of a company are rupees 50,000. The selling price per unit is rupees 20 and the variable cost per unit is rupees 12. It wants to earn after-tax profit of rupees 12,000. The tax rate is 50%. If the fixed cost is reduced to rupees 40,000, what would be the sales value? Here, a fixed cost is an input item and we want to know its effects on sales volume and profit. Suppose the total sales value is rupees X. Variable cost is rupees 12, which is 60% of selling price. So, sales is equal to variable cost plus fixed cost plus profit. Therefore, profit will be equal to sales minus the summation of variable cost and fixed cost, which is equal to rupees 12,000, which is equal to 100% of X minus 60% of X plus 40,000. Rupees 12,000 equal to 100% X minus 60% of X to be multiplied by 1 minus T minus 40,000 to be multiplied by 1 minus tax rate, which will give you rupees 12,000 equal to 20% of X minus 20,000, which is rupees 12,000 plus 20,000 equal to 20% X. Rupees 32,000 is equal to 20% of X, so X will be finally 1,60,000. Let's verify this. From sales of 1,60,000, variable cost of rupees 96,000 is to be deducted, and then fixed cost of rupees 40,000 is to be subtracted. This will give you profit before tax, and the tax at the rate of 50% is to be deducted to get profit after tax worth rupees 12,000. Let's understand now effect of volume change. Sensitivity analysis helps us to know the effect of increase in production capacity and in sales volume on the earnings of the company. Let's take an illustration to understand it. A company sells 6 lakh units for rupees 60 lakhs at 60% production capacity. The fixed costs are rupees 9 lakhs and variable costs are 60% of sales. The company wants to increase its production capacity up to 12,50,000 units by purchasing an additional building. By doing so, its fixed cost will increase by rupees 1,50,000, but there will be no change in its variable cost. Using sensitivity analysis, answer these questions. What would be the change in break-even point? If sales are increased to rupees 80 lakhs, what would be the change in its earnings? Let's solve this. We calculate the answer to all these questions under both the conditions, under present situation and after expansion. Let's discuss present position. Suppose sale is rupees X. So, variable cost will be 60% of X, that is 0.6X. Sales at BEP will be equal to variable cost plus fixed cost. So, X will be equal to 0.6X plus 9 lakhs. Therefore, X is equal to 9 lakh divided by 0.4, which will give you 22,50,000. Now, let's discuss after expansion. X is equal to 0.6 of X plus 10,50,000. X is equal to 10,50,000 divided by 0.4 will give you 26,25,000. At rupees 80 lakhs sales, present position sales is 80 lakhs, which is equal to 48 lakhs plus 9 lakhs plus profit. Therefore, profit would be equal to 80 lakhs minus 57 lakh, which is a summation. So, now you are left with 23 lakhs. After expansion, profit is equal to rupees 80 lakhs minus 58 lakhs 50,000, which will give you 21 lakh 50,000. Now, let's understand a very important concept of cost indifference point. In order to choose between alternative cost structures, the tool used by managers is the indifference point. The indifference point is the level of volume at which total cost and hence profits are the same under both cost structures. If the company operated at that level of volume, the alternatives would not matter because income would be the same in both the alternatives. At the cost indifference point, total cost, fixed cost and variable cost associated with the two alternatives are equal. There may be two methods or two alternatives of doing a thing, say two methods of production. It is also possible at a particular level of activity, one production method is superior to another and vice versa. There is a need to know at which level of production it will be desirable to shift from one production method to another production method. This level or point is known as cost indifference point, and at this point total cost of two production methods is same. Cost indifference point can be calculated with the given formula. Cost indifference point is equal to differential fixed cost to be divided by differential variable cost per unit. At unit volumes below the indifference point, the alternative with the lower fixed cost gives higher profits. At volumes above the indifference point, the alternative with the higher fixed cost is more profitable. For example, assume indifference point for a company's new product is 1,83,333 units calculated like with Q equal to unit volume. Assume the details about two methods of production A and B for the new product. Production method A is equal to fixed cost rupees 4 lakhs, variable cost per unit rupees 7. Production method B, where fixed cost rupees 9,50,000, variable cost per unit rupees 4. Selling price for both production methods rupees 10 per unit. The indifference point will be 1,83,333 units calculated like Q indicating unit volume. Total cost for production A is equal to total cost for production B. Fixed cost plus variable cost is equal to fixed cost plus variable cost of B. So, rupees 4 lakh plus rupees 7Q will be equal to rupees 9,50,000 plus rupees 4Q, which will give you rupees 3Q equal to rupees 5,50,000, which will be finally giving you a figure of 1,83,333 units. At volumes below 1,83,333 units, production A gives lower total cost and higher profits. Above 1,83,333 units, production B gives higher profits. The line rupees 3Q equal to rupees 5,50,000 gives a clue to the trade-off between the alternatives. The company gains rupees 3 per unit in reduced variable cost by increasing fixed cost rupees 5,50,000. The indifference point shows that the company needs 1,83,333 units to make the trade-off desirable. It may be noticed that break-even point for the two methods are production method A, rupees 4 lakh divided by rupees 3 will give you 1,33,333 units. Production method B, rupees 9,50,000 divided by rupees 6 will give you 1,58,333 units. Analytical tools such as the indifference point, margin of safety, and CVP graph help managers to evaluate alternatives, but the decision depends on their attitudes and appetite for risk and return. If they want to avoid risk, they will choose production A, foregoing the potential for higher profits from production B. If they are venturesome and risk takers, they probably will be willing to take some risk for the potentially higher returns and choose production B. Cost indifference point is useful in many decision situations such as quality improvement programs, different marketing plans, production plans or methods, etc. Cost indifference point is different from break-even point. Break-even point compares total sales and total cost of a product. Also, at break-even point, total cost line intersects total sales line. As stated above, cost indifference signifies equality of total cost of two alternatives. At cost indifference point, total cost lines of two alternatives intersects with each other. So, in simple words, a cost indifference point is the point at which total cost, that is fixed and variable, of two alternatives under consideration is the same. Cost indifference point and break-even point relationship. It is necessary to compare and contrast cost indifference point with break-even point. cost indifference point is about equating total cost of two plans or division of differential fixed cost by differential variable cost. It is the point at which total cost lines under two alternatives intersect with each other, whereas at break-even point, total cost line and total revenue line for a particular alternative intersect with each other. Cost indifference point analysis compares the cost of two alternatives. Break-even analysis compares total cost and total revenue for a single product. Let's understand this with an example. Alternative A, fixed cost is rupees 1,20,000, variable cost rupees 7 per unit. Alternative B, fixed cost is rupees 3,60,000, variable cost is rupees 4 per unit. Cost indifference point will be equal to differential fixed cost to be divided by differential variable cost per unit. So, cost indifference point will be 2,40,000, which you will obtain by deducting 1,20,000 from 3,60,000 to be divided by 3, which will give you 80,000 units. Now let's summarize what we have learned. The angle of incidence, margin of safety, is the important concept which helps in decision making. From managerial point of view, a large angle of incidence would mean high rate of profit. A narrow angle reveals high variable cost, which would result into lower or lesser profits. Management should try to maintain a larger angle of incidence. A high margin of safety is the sign of prosperity of the business. A low margin indicates high fixed cost. Business experts suggest studying together safety margin and angle of incidence for examining the soundness of a company. Sensitivity analysis is equally important as it examines the effects of changes in any of the inputs on the expected results. The other important concept which we studied is cost indifference point. In order to choose between alternative cost structures, the tool used by managers is the indifference point. The indifference point is the level of volume at which total cost and hence profits are the same under both cost structures. Hope you enjoyed the session. Thank you very much.